Good morning. Let us see the problems on solvency ratios. Solvency ratios are the measures of the long term financial position of the firm in terms of its ability to pay its long term liabilities. The solvency of the firm is measured by its ability to pay its long term obligation on the due date. The long term obligation includes payments of principal amount on the due date and payment of interest on the regular basis. Long term solvency of any business can be calculated with the ratios of debt equity ratio as well as the proprietary ratio. As I already said, the debt equity ratio is a relationship between the borrowed funds and the owner's funds, whereas the proprietary ratio is a relationship between the shareholders' funds and the total assets. Calculate debt equity ratio and proprietary ratio. Long term debt is given as 4 lakhs, current liabilities is 1 lakh, total assets is 10 lakh, and shareholders' funds is 5 lakhs. Here, the long term debt are the borrowings by the company with a maturity term exceeding 12 months from the date of reporting date. Whereas, the various ways of raising funds of long term debt includes bonds, debentures, term loans from banks, and others. Whereas, shareholders' funds are the total value of investments made by the shareholders in a company. The shareholders' funds includes the total capital of share capital, that is, share capital and reserve surplus. You all know share capital, which is raised by issue of shares by the company. The shares may be equity shares or preference shares. The company cannot issue shares exceeding the authorized capital, which is given in the memorandum of association of the company. Whereas the reserve and surplus is a profit set aside for meeting specific future requirements for any future contingencies. The reserves include capital reserve, securities premium, general reserve, surplus, debenture redemption reserve, etc. So here the long term debt is 4 lakhs and current liabilities is 1 lakh, as I already said, and shareholders funds and total assets is given. So let us see the formula. Debt equity ratio is equal to long term debt divided by shareholders funds. So long term debt is equal to 4 lakhs divided by shareholders funds is 5 lakhs. So 4 by 5, that is 4 is to 5. Proprietary ratio is equal to shareholders funds divided by total assets. As I already said, the proprietary ratio is a relationship between the shareholders funds and the total assets. So here the shareholders funds is 5 lakhs and total asset is 9 lakhs. 5 by 10 is equal to 5 is to 10, that is reduced into simplest form, you will be getting 1 is to 2. Now here let us see the next sum which is given in the balance sheet. Raj Limited presents to you the following balance sheet as on 31st March 2012. Liabilities is given as share capital, equity share of rupees 10 each, 20 lakhs, general reserve 2 lakhs, 8% debentures is 6 lakhs, long term loan is 4 lakhs, creditors is 6 lakhs. So the total is 38 lakhs. Asset side, fixed asset is given as 20 lakhs, stock 8 lakhs, debtors 6 lakhs, cash 4 lakhs. So the total is 38 lakhs. Calculate debt equity ratio and proprietary ratio. So debt equity ratio, the formula we all know that long term debt divided by shareholders funds. So here what are the long term debt? As I already said, the long term debts are bonds, debentures and term loans. So here the long term debt are 8% debentures and long term loan 4 lakhs, 6 lakhs and 4 lakhs. What are the shareholders funds here? So the shareholders funds include 20 lakhs, that is equity shares of rupees 10 each, 20 lakhs, and general reserve 2 lakhs, 22 lakhs, that is shareholders funds. Let us see the sum in detail. Debt equity ratio is equal to long term debt divided by shareholders funds. So as I said, long term debt will be including 6 lakhs plus 4 lakhs, that is debentures, 8% debentures is 6 lakhs, as well as long term loan 4 lakh. So 6 lakhs plus 4 lakh is equal to 10 lakhs. Shareholders funds, I said, share capital and reserve plus will be included. Reserve and surplus will be included. So Shareholders funds is equal to 20 lakhs plus 2 lakhs, that is equal to 22 lakhs. So debt equity ratio is equal to 10 lakhs divided by 22 lakhs, that is equal to 10 by 22, that is equal to 10 is to 22. Let us see proprietary ratio. Proprietary ratio is equal to shareholders funds divided by total assets. You all know what is shareholders funds. So proprietary ratio is equal to 22 lakhs will be given the shareholders funds, whereas the total assets, all the assets which are included here, that is equal to 38 lakhs. So when you say the total assets, you have to add all the assets, fixed assets, current assets and non-current assets. All the assets you have to add it here. So when you add it, you will be getting 38 lakhs. So shareholders funds divided by total assets is equal to 22 lakhs divided by 38 lakhs is equal to 22 divided by 38, that is equal to 11 is to 18. Let us see the next ratio, activity ratio or turnover ratio. We all know that ratio analysis is a technique of financial analysis which describes the relationship between various items of balance sheet and income statements. It also helps us in ascertaining profitability, operational efficiency, solvency, etc. of a firm. It may be expressed as a fraction, proportion, percentage, and in times also. It enables budgetary control by accessing qualitative relationship among different financial variables. Ratio analysis provides us for the information to various accounting users regarding the financial position and viability and performance of a firm. It also lays down the basic framework for the decision making and policy designing from the management. So there we have already seen the different types of ratios, that is the liquidity ratios which are calculated to determine the short-term solvency. Solvency ratio, we have seen these ratios are calculated to determine the long-term solvency. Now let us see the activity ratios which are calculated for measuring the operational efficiency of the operations. These ratios relate to revenue from operations or cost of revenue from operations. So what is activity ratios? These ratios measures the efficiency and rapidity of the resources of the company like inventory, fixed assets, working capital, etc. These ratios are normally calculated on the basis of revenue or its cost. So these are also called as turnover ratio. So here these ratios measures the efficiency and rapidity of the resources of a company like inventory. Inventories means it is a stock. The other name for inventory is stock, fixed assets, as well as the working capital, etc. And these ratios are calculated on the basis of revenue or its cost. So these are called as turnover ratio. So this activity ratios or the performance ratios refers to the ratios which measures the level of activities, the performance of the operating efficiency of an enterprise. These ratios are called turnover ratios because they indicate the speed with which assets are converted into sales. As the assets are converted into sales, they are called as turnover ratio. Depending upon the purpose, a number of ratios can be calculated under activity ratios. So under activity ratios, there are some ratios which can be calculated. That is, you'll call it as inventory turnover ratio or stock turnover ratio. Then debtors turnover ratio or otherwise known as accounts receivable turnover ratio, and creditors turnover ratio, otherwise accounts payable turnover ratio. Let us see this in detail. So here the activity ratios or performance ratios refer to ratios which measure the level of activities, the performance or the operating efficiency of an enterprise. These ratios are also called as turnover ratios because they indicate the speed with which the assets are converted into sales. So depending upon the purpose, a number of ratios can be calculated under activity ratios. So here the different ratios are given. One is inventory turnover ratio, or as I already said, inventory is also known as stock. So stock turnover ratio and debtors turnover ratio, or otherwise known as accounts receivable turnover ratio, and then creditors turnover ratio or accounts payable turnover ratio. Here you must understand what is trade receivable or accounts receivable turnover ratio. Trade receivable includes the total credit sales done by the company and which are pending as at the reporting date. In general ledger, trade receivables are recorded in a separate accounts receivable account and are classified as current assets on the balance sheet if you expect to receive payment from customers within 1 year. Trade receivable is also called as account receivable, whereas the trade payable. So, what is trade payable? The amount payable to vendors or sellers on account of purchase of goods or services which are related to the business are only shown in the heading. The term creditors were used, which is now replaced by the term trade payables. Trade payable is also called as accounts payable. The amount which is payable to the vendors within 12 months from the end of reporting date is classified here, and if it exceeds 12 months, then the same has to be included in other long term liabilities. Inventory turnover ratio. Inventory turnover or stock turnover ratio is a ratio which indicates the number of times the stock is turned over during a year. It expresses the relationship between the cost of goods sold and the stock of goods. So here the inventory turnover ratio. The formula is the cost of revenue from operations divided by average inventory. Cost of revenue from operation includes opening inventory plus purchases plus carriage plus wages and other direct charges minus closing inventory, or revenue from operations minus gross profit. Average inventory is equal to opening inventory plus closing inventory divided by 2. The significance here is higher the ratio shows the higher efficiency. So stock turnover ratio, the formula is cost of goods sold divided by average inventory. So the cost of goods sold is equal to, the formula again is sales minus gross profit, or cost of goods sold, the formula is opening inventory plus purchases plus direct expenses minus closing inventory. Now here the average inventory, how to find the average inventory is average inventory is equal to opening inventory plus closing inventory divided by 2. This is a formula where you're going to find out the average inventory. If opening stock is not given, closing stock itself is treated as average stock. If cost of goods sold is not given, then sales should be considered for the calculation of stock turnover ratio. As I already said, average inventory is equal to opening inventory plus closing inventory divided by 2. If opening stock is not given, the closing stock itself is treated as average stock. If cost of goods is sold is not given, then sales should be considered for the calculation of stock turnover ratio. Now here, compute inventory turnover ratio from the following information. Net revenue from operations is given as 2 lakhs. Gross profit is given as 50 lakh thousand. Inventory at the end is 60,000. Excess of inventory at the end over inventory in the beginning is rupees 20,000. Again I repeat it. Net revenue from operations is given as 2 lakhs. Gross profit is 50,000. Inventory at the end means it is closing inventory, that is 60,000. Excess of inventory at the end over the inventory in the beginning is 20,000. Let us see the sum in detail. Now here, the stock turnover ratio is equal to cost of goods sold divided by average stock. So the cost of goods sold is equal to net sales minus gross profit. The net sales, which is already given as 2 lakhs, minus the gross profit, which is already given as 50,000. So 2 lakhs minus 50,000 is equal to 1 lakh 50,000. So we have to find out the opening stock as it is not given directly. So opening stock is equal to closing stock minus 20,000. So 60,000 minus 20,000 is equal to 40,000. Now we have to find out the average stock. So the cost of goods sold already we have found out. So the average stock is equal to opening inventory plus closing inventory divided by 2. That is, average inventory is equal to 40,000 plus closing inventory is equal to 60,000. So 40,000 plus 60,000 divided by 2 is 1 lakh divided by 2, that is equal to 50,000. So stock turnover ratio is 1 lakh 50,000, as we have already found out, divided by 50,000, that is equal to 3 divided by 1, that is equal to 3 times. Whenever you are writing the stock turnover ratio, you have to write in times, TIMES, that times. So you have to write it in times, which gives you the 3 times. So again I repeat this sum. Stock turnover ratio is equal to cost of goods sold divided by average stock. So cost of goods sold you have already found out, which is given as 1,50,000, which is where you can calculate it directly when net sales and gross profit are given. So net sales is given as 2 lakhs and gross profit is 50,000. So subtract 2 lakhs minus 50,000, you will be getting 1,50,000. And the next step is average stock, you have to find it out. So for finding out the average stock, you need the opening inventory plus closing inventory divided by 2. That is a formula. But the opening inventory directly it is not given. So what you are going to do is opening stock is equal to closing stock minus 20,000. So that is equal to 60,000 minus 20,000, you will be getting 40,000. So average inventory is equal to, you got both opening as well as a closing inventory. So you can add both closing and opening inventories, 40,000 plus 60,000, which you will be getting 1 lakh divided by 2 according to the formula. So you will get 50,000. So stock turnover ratio is equal to cost of goods sold divided by average stock. So cost of goods sold is 1,50,000 divided by average stock is 50,000. 1,50,000 divided by 50,000 is equal to 3 divided by 1, which is given you 3 times.